Hello and welcome to Good Investing. I'm Rachel Grunn.
And I'm Andrea Cwik.
And this week we have, how do we say it? A little bit of a scandalous episode for you because there are some swindlers out there in the investing world, and we just want to bring like a lot of transparency to investing and talk about like very reasonable concerns that investors have when it comes to who is running the sponsorship team.
Yeah, and I think just overall, we want to shed some light on this whole syndication business and how it works, and maybe how we even felt when we got into it. I want to give our viewers a peek behind the scenes on kind of our thought process and getting into syndication, reminding you kind of what that looks like, what it is, and things that you could look for or avoid that will help you make your decisions with investing.
Yeah. A lot of investors say, well, of course you guys want me to invest in this. What are you getting from it? Like what sort of fees are you going to charge me? Like all these different things. And while we don't charge investors a fee per se, like assets under management, like a financial advisor would, right? Like your investment's your investment, your return is your return. We're not taking a percentage of your personal return. Uh, there are still fees that are charged that are built in, baked into the underwriting, right? And uh, sometimes syndicators can get a little greedy, and we've seen it happen. And they will close on deals that maybe they should not be closing on because they're looking forward to that acquisition fee.
Yeah, so I'm going to take a step back and I'm going to say if this is the first episode that you've listened to on Good Investing, we're just going to break down really quickly what we're talking about. So, we're talking about syndications. So, when you are an investor and you want to get into real estate, you can buy a house and use it as an investment property. I have houses that I rent out and they work, um, and they are steady, typically income coming into you on a monthly basis. You own, the house outright. So it is a part of my portfolio. I also have some Airbnbs. I also own them with my family. We have, it's not steady, but it is, we do get a monthly cash flow from it, but it can go up and down based on the different cycles or seasons. That's also something that we have in our portfolio. We're talking about scaling. So, a lot of times when you want to scale your real estate investing business, you can own 30 plus rentals, or you can use some of that money and you can join other investors. And this is what's called a syndication. You can join other investors and pool your money together so that you can buy bigger investments in the commercial space. So why would you want to do that instead of buying on your own? Well, typically when you buy a commercial property, you're talking about millions of dollars, right? So one, people might not qualify for that loan, especially if you're, just starting out or you don't have millions of dollars of net worth. But when you combine your resources with other investors, and typically leaders that also the managers that will manage the asset, they have bigger net worth, so they can qualify for bigger loans. And then that allows you to get into bigger deals with more upside. And that is called a syndication. So I just wanted to break that down just so that our listeners know kind of what we're talking about. So, in joining other investors, in pooling your resources, you're going to do that at a lower cost. So now you don't have to put millions or hundreds of thousands of dollars down when you join a syndication. Typically, you're just putting in 25,000, 50,000, 75,000, 150,000, right? Whatever the deal consists of, whatever model the general managers put on the general partners put onto the deal, that's typically now your choice how much you want to put down or whatever the parameters of the deal are. So let's say it's a $50,000 deal. You can put in your 50,000 out of $6 million that are raised, so you get a percentage of ownership in the deal. So why would you want to do that, right? So why would you want to do that instead of owning your own big asset? Like we said, is the debt, it's the money at hand, but it's also the amount of deals that you could get into. So I can diversify my money a lot quicker and faster if I get into multiple syndication deals. So I could be invested in Georgia and Florida and Arizona. Now that's, for example, 150,000 instead of just putting 150,000 into one deal. But the thing that you have to be aware of is, why wouldn't you want to do it? Right? Okay. So let's talk about that part.
Yeah. So there's always hesitations to it, right? And especially when you're new to the industry, you don't know what questions to ask. We have a whole episode about what questions you should ask a sponsor, which I would really recommend you listen to after listening to this one, because it'll help you kind of weed out the people that maybe don't have the best intentions. And that's not to say everyone's a crook in the business. 99.5% of people that I've met are wonderful people with the best of intentions. And even if a deal goes south, it doesn't mean that it was a scam. It doesn't mean that, things happen, right? And it doesn't mean that the sponsorship team is not good. However, there are things you can do during your discovery phase, during your due diligence, whenever you're deciding who to invest with, what asset to invest in, to kind of mitigate the risk of, should you trust this person with your hard earned capital? Like, that's a lot of money. And like I said, if you're new, you might not know the reputation of syndicators in the industry. So I think for me, at least, the biggest thing I look at whenever I'm passively investing with a syndicator is transparency. Um, I want to see all of the financials. I want to see not just the pro forma, which is like kind of the projection of what they expect to happen at the property. I don't just want to see the pro forma. I want to see why the numbers on the pro forma are what they are. So it also depends on your sophistication level, because if someone sent you their underwriting document, you might not know what you're looking at. And so that might not be a good thing for you to review because you would have no idea what it meant. So it just depends on the level you're at. You can always ask other syndicators their opinion as well on investments you're looking at. But transparency is huge. You want to make sure that they are transparent.
Yeah, so I will say this. When I wanted to scale, right? So we were building up our portfolio as a family, and I'm just like, I really want to scale fast. I'm impatient. I want my money to work for me, and I'm invested in, Airbnbs, single family. I'm doing the fix and flipping. What more can I do to expedite the growth so that, the point of retirement or financial freedom is a lot closer than it is just owning like a single family portfolio? So with that in mind, I used Google and I was like, how do people get rich, right? And I remember going to an event, a real estate specific event. And mind you, I'm from corporate, right? I know nothing really about real estate investing. I am learning as I go through trial and error. But I go to an event and the guy is talking about multifamily. And so we end up wanting to, instead of, listening to Bigger Pockets podcast or reading a whole bunch of books and self educating, we're like, okay, we went to this guy's conference. And I think we paid like, I don't know, $300 to $500 per ticket to learn about multifamily. Well, there at that conference, basically, it's a sales pitch that they sell you a mentoring program. We got sold a $35,000 mastermind, which, mind you, the mastermind did not get us into any deals. The mastermind was good and we got good connections, but it was not what we technically expected. Although we got access to a course, I think, but or maybe we didn't. I'm trying to think back. It's been a few years, but anyways, long story short, that mastermind that we paid for was good for relationships, didn't quite teach us everything about multifamily that we wanted to learn, had to pay another 30,000 for learning multifamily. So, I'm telling you, education is expensive if you want to shortcut the process. But we paid for the mentor, right? So we're like now $65,000 in, plus we paid for multiple trips in the mastermind, each one about $10,000 to $15,000. We took 3 to 4 of those with, our mastermind group. So now we're just like ridiculously into learning about multifamily, which is great. I will say though that the education wasn't cheap. It was expensive, but you could learn, the same amount of things with probably a less expensive mentor, but this is who we decided to go with. Um, and the deal, basically, we did as much as we could of learning. But at some point, if you don't know and you haven't been raised in real estate investing, at some point you're just going to have to take the leap of faith if that's what you want to do. Like there is no I, there's no like magical step that I took besides saying, all right, I've educated myself, I've invested money. We've never sent a wire to anyone to manage our money because we didn't decide to go with a financial advisor, with our stock portfolio or anything. So at some point, you're just going to have to let go and see if it feels right to you. For us, we decided to take that leap of faith because we're like, you know what? We're in it. We're going to trust this team. The team looked credible, right? They had some years of experience. They also had proven to give returns to their previous investors. So we decided to take that leap of faith. So that deal we're still invested in. They have not sold that deal yet. Then we went on to another deal, and we're like, okay, we're putting that $75,000 to work. Now let's see and get into another deal. So then that deal was like 50,000. We knew a little less about the team, but they were still part of the group that we knew. So we took another leap of faith. And all of this to say that at some point you're going to have to take the leap of faith if you want to scale, and you're going to have to trust the team that you're getting into the syndication with. But if you have the access to them to ask them questions and you see a good history, a good return model, or you ask to talk to their investors about their experience, um, I think you're less likely to kind of get into a bad pickle. But there's just deals that do well or don't do well. It doesn't mean like it's a scam if a deal doesn't go well. It's just kind of the nature of investing, and not just real estate investing. I'll just say investing overall. Like when you pay a financial manager to invest on your behalf, you're trusting them, but they don't always hit it out of the park. In fact, sometimes you lose some money, and that's just due to the environment. And so The same thing can happen with the syndication. You can do everything possible to educate yourself. You can do everything possible to meet the team, know the team. But at the end of the day, it is still an investment that carries some risk to it. But getting to know your operators, your general partners, and creating a relationship with them is definitely important.
Yep. And also knowing the great questions to ask. So I'm going to plug our episode again. Please go listen to it. All the questions you didn't know you needed to ask a syndicator, I can link it below too, because that's really important. We also have a episode titled "How Do Syndicators Make Money," and that's also a good one to listen to as a passive investor. So it kind of peels back the curtain on the process, and maybe once you kind of know the questions to ask and you know kind of what's standard in the industry, you can suss out bad apples easier. Um, before you end up sending them your money.
Yeah, I would definitely dig into values of your general partners too and ask the hard questions. It's not always about just the numbers on a deal, but it's like the response and their heart behind why they're doing what they're doing. And then if they could really, pinpoint. I know for Rachel and I, giving back is so huge for us. And I can tell you there was a big deficit in my life of not ever learning about investing. And being very comfortable with what I know about the stock market and just putting everything in there. And now I am extremely passionate about telling others about what you can do and invest in the investing world. And that is my driver because I want other people to gain the knowledge that I had to pay a lot of money for so that then they can unlock financial freedom for themselves. And I know for you, Rach, it's very similar too. I mean, different stories, but you have the same
Yeah,
heart.
very similarly aligned, 100%.
Yeah.
Definitely. I love it. Well, guys, definitely reach out to us if you, you know, have questions further about this topic. We are open books. We're very transparent. We love to share our experience, and we will always answer your questions in a timely manner and completely honestly. I know that that's where Andrea's heart is as well. So, yeah, get in touch. You can check us out at goodgoodinvesting.com. We have some cool freebies on our site. Go into our backlog of episodes, especially if this is the first one that you're listening to. This was kind of a lot. So, we do have a lot of episodes that break down in more detail some of the things that we talked about. So, go check those out as well. Well, until next time, don't invest good.
Invest twice as good. Bye.
Bye.